Well, welcome everybody. Glad to have you here today. Got a couple new classes coming up, which we'll talk a little bit about today. And the title of this class will be the first class coming up, a plan to make $3K monthly on $25K with short-term trades. And I'll explain that a little more as we get into it. That's about 3% a week. And that's with short-term trades, 7 to 15-day trades. And the reason you have that possibility is because you have good turnover. If you put on a 7 to 15-day trade, you can get out of it in a week, so there's no overlapping trades. Whereas if you put on a 40 to 60-day trade, you're not getting out on it in a week. So you're using more capital, more overlapping trades. So that's kind of what makes these shorter-term trades one of the things that makes them a little more unique. All right, let's jump in. This class will be recorded, and let's dive in here, as they say. I'll be going back and forth. Well, I'll be good with the slides, and then we'll look at the brokerage platform. I'll be looking at a few other trades today. This is for educational purposes. Class schedule for the next 4 weeks, and this will be more, we did this in the summer where we did an 8-week class in the summer focusing on 7 to 15-day trades. We went Tuesday, Thursday for 8 weeks, and this is going to be a little bit similar, but obviously we have a different environment. We're in the midst of a correction, a February winter storm in Chicago. So this will start November 12th. We'll go Mondays and Wednesdays at 1 Central for 4 weeks. Each class a minimum of an hour. Cost is $397. You can ask questions anytime during or after class. But what's unique about these classes and what's great about it is you're not going to get any more practical. In other words, when we're doing this, we're teaching you, but at the same time we're teaching you, we're doing it. So every trade, we'll be running a plan. Every Monday, we'll set up a plan, class 1, and then we'll implement it for 4 weeks, all live trades. You'll see every adjustment, every breath, everything for the 4 weeks as we're doing it. So you'll get good teaching on the short-term trades, why we do what we do, which strategies, and as the markets, and it's a very interesting market right now. So we'll show you how we're tweaking it. If the market's still pretty volatile in 2 weeks, I'll be tweaking it. But this isn't just teaching and talking theory. Everything is going to be put on, right? We're going to talk about the plan on class 1, and then we'll implement the plan on live trades. You'll get adjustment updates for 4 weeks. So if you want to get an idea, if you're saying, hey, I'd like to get a little more independent. I'd like to know how to do this, the practical part, not just talk about a spread, but when to put a trade on, how to execute it, how to make a plan, when to adjust it in a certain volatility environment. This is going to be the most practical class you'll find. Right? This isn't a theory class telling you a bunch of stuff. We're doing it. You can see it. The good, the bad, the ugly, you'll see it. So that's starting November 12th. That'll be focusing on short-term trades. But if we're still real volatile like we are now in 2 weeks, we'll show you how we would tweak some of those 7 to 15-day trades if the market is still volatile, if we're still in the middle of this winter snowstorm. And that's that. Now, just to let you know, right after that class, and what I'm thinking of doing for those who are in that 4-week short-term class, just for the people that are in that class, because it'll just be a continuity, after that 4 weeks, we may offer for a small price coming back in and do another 4 weeks to get them more practice so they can get a little more independent. And that would be just for the people that are in that class to get more practice. Because, again, we'd be doing everything's live trades. Again, the idea is to help you get independent. And just talking about it isn't going to do it. After this class, we have a nice, exciting class coming up. After this 4-weeker, Mark Fenton and myself will be managing a live retirement account. And what we want to do is a little different emphasis. how to manage a retirement account. And so this will be long-term, short-term, all different types of strategies, how we would put it together. And we'll be managing a live retirement account, which a lot of you have, right? How many of you have retirement accounts where you trade options in? How many of you have retirement accounts where you trade options in? I would think a lot of you. So that's what we're going to do. The class after this one will be strictly retirement account. How would we do it? How would we do it? And again, everything will be transparent. What's the plan? Every trade, and we'll implement the plan live trades in every class, exactly how to do it. All right. With that being said, now these slides were from yesterday. We'll look at the live market in a second. These are some slides from yesterday. Where's SPX right now? I think we're a little bit maybe within 10 points of this. Are we still around the 2710, 2715 area? Where are we in SPX right now? Are we around that? Oh, so we've gone back down a little bit, probably going to test the lows again. All right, we're about 2706, heading towards the low end of the range of the day, would be the 200-day moving average, right, at that point. So as you can see, we're up near the 200-day moving average and kind of the middle of the Bollinger Band. Robert says, selling off going into midterm election, expect vol crush after results known. That could happen. Yeah, could happen. And then I have a couple things here. I have an get this on Thinkorswim, but call it ATR, average true range, and you can put an 8-day or an 11-day. I usually look at an 8-day, but I got 11-day here, and that's just basically measuring, which everybody knows, the ranges of the day. We've had pretty steep ranges between the high and the low, and that's what the ATR measures, the difference between the high and the low on a given day. So when you're looking at a price chart and you get these big candles, that's saying the ATR is going up. We're getting wider ranges. And so for income traders, especially if you're managing shorter term trades, would you rather have large candles and big room between the high and the low, or narrow? What would you rather have? If you're trading shorter term trades, would you rather have on a price chart big candles or narrow? And so just to give you a little perspective why the ATR is still pretty high, if you look at the last 2 weeks, let's just take this week, and I'll just tell you this, and SPX, the difference between the high and the low, today it's 56 points. Yesterday it was 33, Wednesday it was 31, Tuesday it was 50. Monday of this week, the range between the high and the low, you can see it's probably one of these big candles here. The red one was 103 points from the high and the low. That's big. Last week, Monday, what did I say? Wait a second. Today is, okay. Last week, Friday, the range was 64. Last week, Thursday, 55. Last week, Wednesday, 92. Tuesday, 62. Monday, 29. So the bottom line is, when you have a high ATR, when you have a price chart with these big candles, it's basically representing close to 40, 50 points or more range between the high and the low, and that can make it a little more uncomfortable managing trades, especially if you're doing adjusting. So that's something I look at because that gives me at least an indicator of, if I'm going surfing in the ocean at Huntington Beach, are the waves going to be 10 feet or 15? Hey, I'm used to 4-foot waves. When they get wider, it's going to be a little more uncomfortable, right? So I might not stay out as long, or with trades, I might do smaller size. I like to look at the implied volatility. This is the implied volatility of SPX. And because I want to see the trend of the implied volatility. And again, it's heading down a little bit right now. And that is just, obviously, your out-of-the-money calls are lower, your out-of-the-money puts are higher, and this will give you in the middle of the range. And then you can see how it compares with your historical volatility That's the volatility of the underlying. And you can see it's just showing that, from a close-to-close basis, SPX has been more volatile the last 2 weeks. That's all. And again, I think this year is different for a lot of you, right? If you look at the last 4 or 5 years, just for a second, exclude 2018, how many were getting used to 2015, 16, and 17, where the market goes up and the volatility's low? How many were getting used to that? Market goes up, volatility low. Market goes up, we get our 10% or 15 volatility low. So people doing covered rights, cash secured puts, put credit spreads, long diagonals, they were whispering to their wives and their husbands, I think I discovered gold, honey. Don't tell anybody, right? And really what it was is you were doing positions from the long portfolio that were neutral to bullish and the market was going up. But this year was a little bit of soberness. Why? After having no corrections in the previous 2 or 3 years, you have one correction in February, you have a smaller one, maybe 6% in March, and then another correction here. So for people used to just sell a put, do a covered right, every time the market goes down 4%, it'll come back. I'll get my 12%. It's like an annuity. No, that's not normal, right? A little bit of movement. But should you have some of your portfolio allocated to long portfolio? Yeah. Should you have some of your portfolio allocated to a strategy in the long portfolio, neutral to bullish? Should you pick a cash secured put or a short put or a covered right or a long diagonal or a bit of a collar at times, or in our community, out of the money put broken wing butterfly, just that specific butterfly will be more neutral to bullish? Yeah. But again, can you get by over the next year having all of your money in long portfolio strategies, just believing we'll always go up? We make 12% every year. It'll be beautiful. No work, make money. No, wake up. So looking at some trades here, and this is what we're going to do during the 4-week class. What I'm going to do at the beginning is assess the market, tell you how I'm assessing it, make a plan based on the market in 2 weeks and the volatilities, and we're going to drive our car. Everybody's going to get in the car. We're going to drive the car through that 4-week period and show you how, regardless of what's going on in the market, we're going to tweak how we tweak the strategies, maybe how we go from one to the other, how we pick them. And that's the idea. Show you how to do it. Why? So you can do it. Are we going to do like you see typically on webinars, give you a little bit to sell you a newsletter? No. We're going to show you how to do it because I think that's right. So you can learn how to do it, right? So we're not going to keep anything from you. We're going to do it, and we're going to show you how we're doing it, and with the idea to help you do it. All right. So here's a strategy. Just give you an idea of some of the strategies we'll deal with. Now, again, some of these strategies we may or may not do depending on what are the price levels of the market when we're having class in 2 weeks. What will be the volatility levels? So some of these short-term strategies we will somebody says I have 3 puts shown. Where do you see 3 puts? Am I looking at the right screen? Tom says, are you really selling 2 puts and buying? I'm looking here, I'm buying, oh, maybe I screwed up here. Okay, thank you guys. Typo. Can I say typo in English, Spanish, and a little Portuguese? So here's the typo. The typo will be this put, sell 1, Nov 9, 2770, call. So that's a double, that's just an example of a double calendar. This is a iron condor alternative when volatilities are lower, or you think the market's maybe going to head down a little bit and volatilities will go up. But again, here's what I want to be clear on, and here's what we'll be emphasizing in the class. These are 7 to 15-day trades. We're looking to be in these trades 2 days to 3 days max. So what does that mean? We can turn it over. We can put on 2 trades a week on a covered rights or a low-risk trade. You can look me in the eyes and tell me a cash secured put or a put credit spread is low risk, but that's not reality. So comfortability, right? Long portfolio strategies over the last year or two have been comfortable because you haven't had to work or do anything, but they're not low risk. So here's a butterfly trade. A couple questions. Doing these trades in SPY have the disadvantage of the possibility of being assigned the security. Let me just address that. How many people are scared of being assigned on short options? Well, let's remember, is that a controllable situation? Yes. When do you get assigned? When the extrinsic value disappears. So if you're watching the time premium in your short option, let's just make for easy example, if you have a stock without dividends, just the easiest example. If you have a stock that doesn't pay dividends and you're looking at the short option and maybe you sell it initially and there's $1 a time premium, and then all of a sudden the time premium, as the market goes up on a covered right, your time premium goes from $1 to 70 cents, to 60 cents, to 50 cents, to 40. But when that time premium starts getting about 20 cents or under, that should be a clue for you. Close it and roll it out. Let me ask you a question. How many of you don't play the lottery because it'd just tick you off that you'd have to pay taxes on $1 million? Here's the problem with being assigned on short options. If you were to get assigned, I get it, you don't want to get assigned on the stock, right? And it's not a totally good analogy, but the point is, if the market's going up and you get assigned on your short stock, are you making money on the trade or losing? Are you making money on the trade if you get assigned on a short call and a covered right? Are you making money or losing? Do you know the answer to that? Are you making money or losing money if you get assigned on a covered right on the short call? Let me ask you again. Are you making, in most cases, right? Elliott said it depends on the position or setup. In 94.5% of the cases, you're stinking making money on the trade. Let me say that in Spanish. El cuadro, el meco, el monio, right? You're making money. What you should be concerned, right, if your ticker was working, what you should be concerned about on a covered right is not the stinking upside. It's the downside. Ladies and gentlemen, get your priorities right. Jerry says, on a double calendar, Dan, do you wait till the short options expire to close the trade? And how much money do you expect to make on a one contract double calendar? Jerry will talk more about it during class, but I'm looking on a double calendar. No, we have a plan. We're trying to make X percent on the trade. When we get that, we'll take it off. We're going nowhere near expiration. On these trades, on these income trades, the way to get the probabilities really in your favor and to take less risk is you might only stay in them a third of the duration, Jer. A third of the duration. So we're not going anywhere near expiration. Here's a butterfly. What's the foundation of a butterfly? What's the foundation of a butterfly? The foundation of a butterfly is sell an out-of-the-money call, sell an out-of-the-money call and put, or sell 2 out-of-the-money calls, but you're selling out-of-the-money options. Why would anybody sell out-of-the-money options? Why would anybody sell out-of-the-money options? Why? And one thing Dwayne says, what is the chart? All our classes are recorded, and you can watch them 432,000 times. And when you rewatch them, you can ask me questions all the time. Now, why would you sell at-the-money calls and puts? Because those are the options at the money that have the biggest time premium. So when you sell those, the minute it's like selling a new car, if you could. When you sell those at-the-money options, it's like, here's all you're hearing. What is that? That's the air going out of the balloon, right? So why do you sell at-the-money options? Decay. So in this position, we're selling the ones with the most time premium, buying in the money and out of the money options with less time premium, and that's where you have, that's why a butterfly, you're just selling the option with the most time premium at the money. That's why you can see the potential for good rewards if we don't move much, because these options will decay a lot more than these. So we're talking about trades where the foundation is selling it out of the money call and put, like an iron condor or a double calendar. We talk about strategies where you're selling that big, juicy apple, those at-the-money options. That's a butterfly or a calendar. And those are some of the strategies we are going to talk about. And then here's an iron condor, which is something I'd be looking at more than a calendar trade in this environment. Why? This has got the same foundation as a double calendar. Iron condor, selling out of the money call and out of the money put. Selling out of the money call and an out of the money put. Selling out of the money put and an out of the money call. Why would you do it? To get the probabilities in your favor, to get time decay in your favor. And then I buy hedges 10 points away, so I have credit spreads. Why do I do that? I have a range-bound trade. I make money between this area, right? So even if, let's say some of you are saying, hey, Dan, all I do is beautiful, conservative, even though it's not, long portfolio stuff. Dan, I just do collars and covered rights and cash secured puts because the market will go up and up forever. And others of you say, Dan, all I do is I make all my decisions on pivot points and quaddle points and Fibonacci and Fibonacci, and I'm just a technical wizard. That's great. Those are two parts of your portfolio. But you also need this part of your portfolio range-bound, decay, probabilities. Let that work for you. So even if you're a directional guy, as you found out, the market doesn't always go one direction, right? And a spec person, it's not always easy to pick. This is range-bound stuff. This is something you can do without going to Fibonacci restaurant or going to Elliott Wave restaurant, right? All right, so iron condor, we're selling out of the money call, out of the money put. The deltas on this, somebody was there, how did I pick the short strikes in this iron condor? The call was a 13 delta in this particular one. I don't always do them like that, but in this one, and the put was 15. So I want to be far enough out of the money to get the probabilities in my favor, but I don't want to get like a 5 delta, something way out of the money. Why? Because I don't get enough money, and I want to get good theta. So most of these 7 to 15-day trades, as you'll see during the class, we're going to be out in 2 to 3 days at the most. 2 or 3 days? Now think about this. I want you to think about this next statement. If I'm only in a trade 1 to 2.5 days a week, can I lose money on that trade the other 2.5 days? Yes or no? I cannot lose. Say, Dan, why can't you lose? If I don't have a trade on, under the law of the Illinois State Constitution, paragraph 3, sentence 2, part 4, says if you do not have an option trade on, you can't lose money. So people always say, well, I don't want to trade short-term options. You know, it's just too crazy, and I'm too busy at work. You know what? Talk to somebody who's traded short-term options. What they'll tell you is 50 to 60% of the time they're out in a couple days for the profit, right? So there's a perspective. And so, this is an opportunity for you to come and do it. We're going to do it, right? We're not going to talk about it or assume. We'll do it, and you can see for yourself, right? Do I send out alerts of action required on everything? Yes. As soon as I make a trade, if I make an adjustment, I'll let you know. But here's the good thing. Bill, remember, I'm trying to make you independent. So like an alert service, here's the beauty of it. When I do these trades on Tuesday and Thursday, I'm telling you when to adjust, when I'm going to adjust. I'm telling you ahead of time. Managing a retirement account. Then starting November 29th will be a free class introducing the managed by a retirement account. And then Mark and I will go 4 weeks. These are the dates. And this is strictly, we'll have a live retirement account and we'll manage it and show you how we're doing it. So I think that'll be helpful to you. All right. So just for a second, let's take a look at the market. And right now we're at 27. Can you guys see my screen here? Right now I'm just looking at the chat box. So if you have any comments or anything, just put it in the chat box. Elliot says, aren't the slippage and commission costs on short-term trades significant as percent of margin? Or Matt says that, I'm sorry. Aren't the slippage and commission costs on short-term trades significant? No, I mean, again, here's the key. Most of you should be getting, how many of you are getting at least $1 a contract, no ticket charge? Yes or no? How many are you getting that you're paying commissions $1 a contract, no ticket charge? $1 a contract, yes or no? Yes or no? And you got to be careful. Like Matt says, 50 cents. You got to be careful. Some places, like if you're at Tastyworks, right? Tastyworks will say 50 cents a contract or whatever. But if you're doing SPX, you pay 60 cents for the SPX fee. So you got to be careful. Is your brokerage firm passing on the 60-cent SPX fee, correct? In other words, we get a rate of $1 a contract, no ticket charge at Thinkorswim. Are they passing along any fees to us? No. Are they passing the SPX fee? No. So Matt says TD, not with us. So Matt, TD Ameritrade charges us $1 a contract, no ticket charge. And so, but again, no, commissions are pretty reasonable, so it doesn't eat up that much of your profits, if you have a decent rate. But I mean, it's pretty easy to get a decent rate these days. But if anybody thinks they're paying a lot too much, you can email me, Dan at Sheridan Mentoring. I try to help you. So right now we're at 27.19. We're not that far away from the 200-day moving average. And let's just look at one trade. I'll just look at one trade for a second. Here's a trade I was talking about in a session earlier. But let's look at so in this environment, one of the things that I've been doing is a little bit further out because the volatility is higher. VIX right now is 20, which is a pretty decent level, pretty high level. So based on that, I'd go a little bit further out. So I'm going to look at just so you can see, I'm going to go out to December. You guys see this? December 14 is 42 days out. I'm on Thinkorswim platform. Now, for those of you who aren't used to it, I'll just show what I'm doing here is I'm in the D14 options. So I'm doing this because when option volatilities are higher, when VIX is 20, what that's telling me is time premiums are juicier. So if time premiums are juicier, do you want to go and you want to sell them? Do you want to go closer in or further out? If time premiums are higher, that's what happens when volatility increases. It jacks up time premiums. Would you rather sell fatter time premiums further out or smaller time premiums closer in? When time premiums and volatility goes up, you'd want to go a little bit further out duration. So here we are 42 days. And I'll just show you an example of a trade that I would do. I mean, I'll do one. I'll do a contract just so we can talk about execution. So here's a trade. Let's do an iron butterfly. How many have done an iron butterfly? I'm clicking iron condor just because that's the way you have to enter it on Thinkorswim. People ask me, do you know how they got the term iron butterfly? I don't know. I don't know. Now, the only thing I think of is Iron Maiden. Does anybody remember, anybody old enough to remember the rock band Iron Maiden? Are they still alive? Are they touring like everybody else in their 70s, touring? Iron Maiden, I remember that. So again, remember, so let's look at this trade. An iron butterfly. Let's look at this trade. Hold on here. That graph is not the position. I'm constructing it. So remember, what is an iron butterfly? An iron butterfly is starting out with the foundation. Stay with me. Selling out of the money call, selling out of the money put, selling out of the money call, selling out of the money put, selling out of the money call, selling out of the money put. Well, why would you do that? Why would somebody that calls themselves a sane person selling at the money call and put? Remember this sound. You're selling options that decay over time. But because we're sane individuals, we want to, so I'm going to sell the 2720 calls, sell the 2720 calls, sell 2720 calls. Why am I selling the 2720 calls? Because we're at 2720s. And I said, I'm selling the at the money call and put. That's what I said, right? So I'm selling the at the money call and put. That's the trade. But because if I sell an at the money call and put at my brokerage firm, they'll charge me more money than most countries have. So I've got to buy a hedge. So let's just say in this case, it's 42 days out. I go buy my hedge 50 points out of the money, 50 points out of the money. So if I'm selling the 2720 call, which call would I buy? If I'm selling the 2720 call, which call would I buy? If I want to buy something 50 points out of the money, what strike is that? 2770, right? Why am I buying that? I need a hedge, right? It'll be too expensive to just sell naked options. On the puts, I sell the 2720s. Which put do I buy? 2670. So here I have this living, breathing organism called an iron butterfly. So Dan, what are you doing? Right? Sing the song with me. You ready? I'm selling an at the money call and put, right? I'm selling the 2770 call. I'm selling the 2770 put. I'm selling the at the monies, and you can hear them going. Here's the underlying 2720. And I said it wrong. Don't listen to me. 2720. 2720. 2720. Now, what I want is selling the straddle, the at the money call and put. Selling straddle, buy the wings 15 points away. So I'm buying the 2670 puts. I'm buying the 2770 calls. And this is the expiration graph. This is the T plus 0 graph is this one. The T plus 0 graph is this one. That's the graph today. This is the graph at expiration. Whoops. The red one. Now, the position Greeks, by doing this trade, my deltas, that's a symbol for delta, is about short 3. Matt says you're extra chipper today. What did you eat for lunch? What did I have for lunch? I had some soup, Matt. Oh, I had some soup. That's it. Let's see. Gamma. That's how your deltas move against you. Chipper. I like that word, chipper. Theta. This is normal on a 43-day trade. But the bottom line is that, and it's short Vega. So all we're doing is, as long as we're in this area, we're hearing this sound. As we're moving outside of this area, we have to fix it, take it off, adjust it, or whatever. So these are, again, income portfolio trades. So, folks, and thank you, Dino. Dino's giving. See, I knew Dino would come up with why we call it iron butterfly, and so that's for your edification and learning. You can read that. So, folks, if you have any questions, this should be available for you. If you have any questions on what I talked about today, any questions on the upcoming class, you can email me, Dan, at SheridanMentoring.com, and we look forward to seeing you again the next two classes. If you want to learn this, if you're saying, Dan, I'm getting beat up in these markets or I'm having a rough time, come in. Let's talk. Let's help. Let's build a plan. Let's trade this together. Let's shore up the risk management. And the great thing is this will be practical. Every trade will be transparent, but we're showing you how to do it. This isn't a mystical experience, right? Based on if I can see Fibonacci's eye better than you can see Fibonacci. No, none of that. You're going to put these repeatable trades on. So we'll see you in a couple of weeks. Have a great weekend. Would I do these trades in a big ATR environment? I would, and we'll talk about how we may tweak them. Again, I don't know how, for the short-term strategies class, I don't know where we're going to be in 2 weeks, right? We may have been settled down. We may not. But regardless of what we are going to trade the short-term trades for 4 weeks. And if we're in a more volatile environment, I'll show you how I would weatherproof them, how I would tweak them in that environment. Or maybe I would move out a little more duration. But no matter what the environment is, we're going to trade. And we'll just show you how we would do it based on the weather conditions. And really, that's what you need to learn. No matter what strategy you're trading, you're going to have to learn to trade it through different weather conditions. Anyways, if you have any other questions, let me know, and we'll see you next time.